People may look like they're wealthy, right? But they may be really in debt and maybe can't afford what their lifestyle.
What's up, family? And welcome to the Leader Diaries podcast. My name is Justin Mohabir. I'm a 22-year-old who interviews NFL and NBA players, business executives, and CEOs. My goal is simple. It's to help develop the leader within you and that you can unlock the best version of yourself. Every day is an opportunity to learn, grow, prosper, and bless somebody. Because when you stop learning, is when death begins. On today's episode, we have my good friend, Chuck Adcock, the CEO of Champions First Credit Union. He'll be discussing the credit hacks and financial mistakes that a lot of young people make.
Yeah, excited to be here. Thanks for the invitation.
For sure. So, Chuck, what is one financial mistake you see a lot of young people make that they fail to realize?
Yeah, probably the thing that I see the most is folks will, especially when you're younger, you're in acquisition mode, right? Like you're trying to acquire things, build out whatever your asset base looks like. So we see a lot of folks go into credit card debt early. That's probably the number one thing we see is just young people coming in with too much of unsecured debt and really nothing to show for it, right?
Right. So what would you say is like something they need to understand when it comes to building credit the right way?
Yeah, so the thing is you have to understand that like credit cards are a critical part of the FICO score computation. If you go to myfico.com, you'll see the 5 categories that make up the credit card. And one of it's capacity, right? It's how you manage credit card debt, essentially. It's a big part of the score. So it's important that you have a credit card and you get used to using a credit card and create the financial discipline of it. But you don't want to be so far in debt with the credit card that it begins to be like an anchor around your neck, right? Like you want to make sure that you're able to manage that.
So at what age can someone start to build their credit score?
I'm a big fan of 18, right? As soon as you're of majority age and you're legally permitted by law to sign on a contract and covenant yourself with a financial institution. Now, I remember when I was 18, like my mother would tell me, like, don't get a credit card, don't. And these were well-intended, good input from my mom right at the time. But what wasn't around when I was 18 was the FICO score. And now that the FICO score is embedded in so many different ways in our lives, it's important to go ahead and start that credit as early as possible. So if you can get a credit card at 18, either on your own, or if you have to pledge money as collateral, do a secured card, or even potentially getting on as a cosigner with your parents, it's important to go ahead and start getting that credit score established.
You said something important here. You said a co-sign with your parents. So almost like being like an authorized user.
You could be an authorized user. So you got 2 different things, right? A cosigner would be where like you're the primary and your parents are co-signing. And so they're basically going to the financial institution and saying, as an enticement to give my child a credit card, I'll guarantee that the money gets paid back, right? That's the cosigner situation. The authorized user situation is where the parent already has the card. The relationship is the covenant or the document is signed between the parent and the credit card company, and the parent saying, you can add my child to the card and I'll be responsible. It's my card, so I'm already responsible for it. I'm just giving them access to it, basically. But what you have to understand is when you drop off of your parent's card as an authorized user, so will the history of your usage of that card. So it's better for you to get the card and your parents co-sign it to the extent they're willing to do that and that they're qualified to do that.
So could someone technically in high school be an authorized user of their parents' credit card?
Yeah, you could technically be 5 years old and be an authorized user on your parents' card. Maybe maybe too extreme. But the point is that you don't have to be of majority age to be an authorized user because the covenant between the borrower and the lender is between your parent and the financial institution.
You can build your credit as an authorized user as well.
Yeah. Now you can, but understand that let's say now you fast forward, now you're 25 and mom and dad say, time for you to get off my card. Well, then the history of the use of that card on your credit report will go away. So that's why I say the better way to do it is either to get the card on your own, if you can qualify on your own, or get it with your parents as a cosigner.
So $1 billion question. Finance is built on trust. That's the name of the game. How does a person build that financial trust, before they request for funding, a small loan, a business account?
So it's a great question. There's two parts to it, right? One is, as a young person, you want to establish your credit, right? And so you want to do that with whatever levers you can pull to make the credit score be as strong as it can. And that's going to be different for everybody, right? So I definitely recommend you getting a credit card and having and learning the financial discipline to manage the credit card. Young people may have student loans, right? And so that's a great way to, these begin to be new trade lines on your credit report. When you graduate, you start making the payments on them. And so that's instantly an opportunity to demonstrate credit worthiness. Maybe you need a vehicle, right? And maybe you work while you're younger, whether you're in college or not. Maybe you're working, you go buy a used car and then you qualify for that loan. Whatever lever you pull, you want to make sure you're paying your bills on time, managing the debt. Now, when it comes to the trust side of it, though, let's say you're someone who's an entrepreneurially minded student or young person, or you want to apply for a larger loan, at a younger age. That you're going to want to do by having a good relationship with the financial institution that you traditionally bank with, right? Or you generally bank with. Let's just use a hypothetical and say you're an entrepreneur and you want to borrow for startup cost. That's where you're going to want to go in. You're going to want to have had some kind of banking relationship with the financial institution. And then you're going to want to go in and sit down with one of their folks and do some planning with them on how to prepare yourself for that larger loan. That way you just don't come in without some kind of guidance or some kind of guide rails as to what to expect.
I want to go back to your first response. You said something important. Building that financial trust. Ideally, you want to do it with an institution that you already have some type of history with, some type of chemistry with.
Yes. Because you think about in the modern era, especially for today where we live, you can go online, never interact with a human being, make an application for a loan at a limitless number of lenders, right? You put in your confidential information and they're going to pull your credit, and it's usually going to run across some kind of automated algorithm that's either going to qualify you or not. There's no human interaction with trust. There's no one who's hurt your business plan. There's no one who understands, what the way you've managed your accounts. And there's no history between you and that entity, right? The beauty of going in and developing trust with a relationship, particularly with like a local lender, and there'd be some people that argue that you don't have to do it with a local lender, but the point is if you go in and you sit down with someone that you're developing a long-term banking relationship with, and you let the lender, in this case, the bank or credit union, have a good understanding of what you're trying to accomplish, then they're going to be able to help you navigate their internal policies and programs to help you prepare, because their job is to try to make a loan where they can. And so they're going to try to help you navigate that. And you don't get that interaction when you're doing it in an automated environment online. That's not to knock the automated online environments, right? They have a place. But for a young person starting off or a young business owner trying to expand, that's where you're going to want to have that stronger relationship.
For people who don't know the difference between a credit union and a bank, would you please explain that to us?
Yeah, there's so many nuanceical differences. The easiest way to explain it is that a bank is owned by shareholders, and the bank creates profit to pay to create value in those shares, right? A credit union is owned by its members. And since it's owned by its members, it's a financial cooperative. So everybody's working together to create the best value. And rather than creating value for the sake of driving stock price or a dividend, we're creating value for the cooperative spirit of everybody. And so generally credit unions are going to have higher deposit rates and lower interest rates on loans, because basically when credit unions, we make money. And at the end of the day, when we make money, we give it back to the membership equally, as opposed to it going to stockholders, if that makes sense. There's tax treatments, there's all kinds of other things, but that's kind of as an end consumer, that's what you should know, is that's how they operate differently.
So do you believe that everyone should do business with a credit union?
So I'm super biased, right? Like I've been in the credit union business for 32 years. I'm CEO of a credit union. I do believe that the average consumer can do business with a credit union and meet all of their banking needs. Now, there are some times where there are transactions, sometimes international transactions, sometimes more sophisticated commercial transactions that require maybe a different expertise.
Well, you say it's like the biggest credit hack, which people would know.
The thing that I always like to do is I like to make sure that people understand the FICO score, right? And so I think as a consumer, the better understanding you have FICO score, maybe the better positioned you are for not just credit issues, right? So I'm a big fan of the FICO scores website. Like I mentioned before, it's myfico.com, myfico.com. This is Fair Isaac's company's website. There's plenty of tools on there where you can get a good understanding of the 5 categories that make up the FICO score. And being educated is the biggest credit hack, right? Because there's so much misinformation on the internet. I read stuff all the time, pops up in reels and stuff, and I chuckle sometimes because there's going to be some influencer or some social media expert that's like, do this and do that and do this. And I'm like, well, that works like for a day, right? It might trick the score for a little while. So I'm a big fan of going to the source, right? FICO makes the credit score, go to their website, understand how it works. And the reason I'm a big fan of that is because your FICO score is not just used in the modern context for credit. Now, that's its primary role, but landlords look at your FICO score, potential employers look at your FICO score, insurance companies look at it. So there's so many different places in your life that intersect with the FICO score or potentially intersect with the FICO score, that understanding how to turn those dials, not that you ever want to make your FICO score go down, right? Like you would never intentionally do that, but understanding what activities that you're doing in your personal finances drive the score up and down. That's the hack right there.
I like what you say. Educating yourself is the biggest hack. And I think about this saying that a wise man was saying, people perish for a lack of knowledge. These days, there's really no excuse. The other side of the coin, what piece of advice do you have for someone who has a terrible credit score and feels like the world is going to end tomorrow for them financially? How can they turn it around?
Yeah, don't give up, right? Like that's my advice. Don't give up. Credit score is a dynamic score, right? Every single input that goes into the score, it recalculates. So you can literally pull a credit score in the morning and pull it in the afternoon and get 2 different scores. They're generally not wild deviations, but the point is that it's constantly working on inputs. So every day in America, lenders all over are remitting their credit files into a central repository, and that's usually with the 3 major credit bureaus, right? TransUnion, Equifax, and Experian. And when those credit bureaus are recalculating scores when we pull them, it's all based off new input. So the score is super dynamic. Don't ever think that because it's really bad, it's always going to be bad, right? But also you need to understand there has to be intentionality to it. You got to pay your bills on or before time, manage your credit card debt or your capacity, keep the bad stuff that you've ever had happen as far back in the future, in the past as possible, keep the good stuff being current. You want to manage how fast you get credit and manage the mix of credit. So if you do those and you do those well, you can recover from any starting point. I've helped countless people start off with credit scores like in the 400s and now have high 700, low 800 credit scores because of just being intentionally applying the 5 categories.
So how does that work, like for couples who are married? Say like there's one partner who has a bad credit score and the other partner has like a 780, right? And then they marry and get together. Does that affect the spouse of the 780?
No. So think about this. I'm going to use it so you can see my hands. You got partner A and partner B, right? Yeah, husband, wife, whatever they are. So if this person has really bad credit and this person has great credit, when they enter the marriage, their credit reports are still independent of one another. Just because they're married, they do not merge, right? They stay independent. But what happens though is now you have dual incomes in the household. And just for a hypothetical, let's say this person makes 50 grand and this person makes 50 grand. Well, now they have the buying power of $100,000, right? So if they go and they want to buy a car or house or anything like that, the lender may say, well, if we only use one of your incomes for the person with good credit, right? We only use this income, then you can only afford this much or qualify for this much. But if we introduce this person's income, then you can qualify for more. But now all of a sudden we introduce their credit file as well. So the lender will look at it in a blend format. It doesn't actually blend, But the lender looks at it. They make their determination on qualification based off of the overall picture of the two borrowers. And then it establishes what I would call the first joint piece of credit. So again, I'm using my little rudimentary hand graph, but think about it like this, right? Now all of a sudden we have our first piece of joint credit. So I've got all of my independent credit over here, my independent credit here, but we have a joint piece of credit under this new loan that we've taken out. And over a marriage and a lifetime, you start getting more and more and more of those connections, right? Where you're sharing credit. And over time too, you'll pay off things that were on your independent, that, you were individually obligated to. And then before you know it, if you take like me, my wife and I came into the marriage with two separate credit files, two separate credit scores. Hers was, they were both good, but hers was a little higher than mine. And then over time, we've borrowed together on every debt we've ever had. And so now if you look at our credit reports, they're a carbon copy of one another, but they're only a carbon copy because we've done everything together. At any point, either one of us could have borrowed without the other person, and we would have it would have still been on a separate credit file.
So the lender, they look at the whole puzzle. They look at the individual credit of both individuals.
If you're applying jointly.
Okay.
So if you go back to your hypothetical, you have one partner who has great credit and one who doesn't. If the person with great credit wants to be the only person on the loan and take it out in their name and everything, the lender doesn't sometimes even know that the other person exists, right? It's only when you apply for joint credit. And one of the strategies I would suggest to help repair the person with the poor credit is to go in joint so that you get the new credit score, and hopefully the financial habits of the person with the better credit will rub off on the person with the worse credit, and it'll help bring their credit score up over time.
Not to be romantic or anything, do you think it's a red flag if your potential long-term partner has a bad credit score?
You see a lot of comedians tell that joke, right? Like, I want to see your credit score before we get dating. Here's what I say about that. I think you have to find out why it is bad, right? So if it's an education issue, not everybody understands FICO, and they could just be doing some things in their normal everyday activity that's hurting their credit score that they're completely unaware of the impact that it's making. That's probably not a red flag. If someone has just really poor financial habits, and it's just they have the knowledge, they understand how it works, they just choose to do the opposite of how it works, well, that maybe, again, this gets into like we're playing Dr. Phil here a little bit. I don't know if that should it change the relationship, but it's certainly something that you need to go in eyes wide open, because if that's the person's current financial habits, and their habits have led to a poor decisioning, which has led to poor credit score, then you have to understand that may be those habits may be what that partner brings into the relationship. Like, most people don't go into it with that attitude. Most time it's a lack of education, or it's life circumstances that cause them to have to make tough decisions as it relates to their financial well-being. And in either case, as I mentioned earlier, it's all repairable.
It's almost like they're saying you should get them the benefit of doubt.
Yeah, I think you got to investigate why it got that way, right? Like, someone could have a really crazy story, like they lost their parents when they were young and they had to be on their own and they had to make some really tough financial decisions, some of which were to the detriment of their credit, but it's what they had to do to survive. Well, that's a whole different motivation than someone who has a closet full of clothes and just has a shopping addiction, right? Like, two very different motivations. And so I think you just have to investigate a little bit.
We talk about college students or like mistakes that young professionals make, young people make. I want to talk about like a wealth detriment, like car loans. For someone who just recently graduated college, is that a wealth detriment? Because, we live in a lifestyle where, people look at the outward, right? Having a nice car versus what I say, Dave Ramsey say, drive the beater. What are your thoughts?
Yeah, so I'm a little all over the map on this. I'm going to answer that question with a story. So when I first started my career, I was working with one of the repossession agents, and I happened to run into him at a Little League baseball game where his son was playing Little League and I was coaching. And I remember we were in an affluent part of Tallahassee, and you have all these really nice cars out in the parking lot, and we're in an area of Tallahassee that's where people with more wealth lived, right? And I said, "Oh, I bet you've never repossessed a car out of this particular neighborhood." And he said, "I repossess more cars out of this neighborhood than I do in the less affluent neighborhoods." And it was like my first introduction. I was in my early 20s. It was my first introduction to the fact that people may look like they're wealthy, right? But they may be really in debt and maybe can't afford what their lifestyle. So when you ask the question about like, should you drive the Dave Ramsey beater versus the nice car, especially if you're a young person right out of college, I think it depends, right? The easy answer is to take the Dave Ramsey approach and say, drive an older vehicle that has no payments on it for as long as you can and take the money that you would have made a payment with and invest it. And that's what most financial planners or advisors might say. And it would be really solid advice. But the reason I say it depends is because everybody's circumstances are different. If you're someone who's an NIL person, maybe you were a high riser in college, but then again, using this hypothetical, maybe you had a catastrophic injury and you're not going to play at the professional level. So you're putting your degree to use in whatever that profession is, but you've got this investment behind you that's churning out money. Well, then if you want to buy a car right out of college because you have this kind of guaranteed income flow, then I don't see that being necessarily a detriment to wealth. If you think about the example of a car, if I drive the Dave Ramsey beater and it has no payment on it, and I would have been paying $500 a month for a car payment, well, that's $6,000 a year I could be investing. And if we do the time value of money, that could be a very big number by the time I retire, right? There's an offset to that, though, because sometimes that old car may require more repair. And so if you have to put more than $6,000 a year into it, you might have been money ahead to have bought the new vehicle that didn't require as much repair, right? So that's why I say it depends. Everybody's situation is very different. You got to look at the whole picture and figure out what works for you, what you can manage, what your financial discipline will allow, and then you pick that course and that path, right? And so there's really a lot of talking heads say this is the only way. I hedge a little bit and say, well, it depends, right?
What about leasing vehicles?
So leasing is a good alternative depending on your situation. Mathematically, leasing is like renting an apartment. You give away your money to someone else for the use of something, right? And you have nothing to show for it, right? At the end of your lease on an apartment, you move out. That apartment, that landlord had all your money and all you had was shelter during that time. Leasing's very similar because you might do a 36-month lease, and at the end of the lease, you either have to buy the vehicle outright at that point or you surrender it back, and you have no obligation at that point. So leasing is good in certain scenarios. If you're someone who can afford to have a car payment in perpetuity and you like a brand new car every 3 years or 2 or 3 years, whatever the lease term is, then leasing is something that you can do. Probably not the most financially sound decision, but if you're in a position to afford that and it makes sense for you, then maybe it works for you. You might be at a business too where there's tax advantages to leasing, right? So if you own your own business, there's more advantages to leasing, especially if you run a lot of miles on a unit and you need to rotate out of units periodically. And then sometimes it's just really good for your personal situation, right? Cars are getting really, really expensive. You're talking about, I read an article yesterday that said that the average age of a car right now on the road is 13 years old, which is 2 years older than it was 5 years ago. And if you go back 30 years ago, a 13-year-old car was a classic, right? And now it's just a common car that people drive. And that's because cars have gotten so expensive. I mean, the average purchase price of vehicles is over 50 grand. And then you get into anything that's moderately high end and you're knocking at $100,000 for a vehicle. Sometimes leasing is really the only affordable option for someone to have reliable transportation.
And now I want us to, go into your diary, aka your story, yours as a teller at the credit union, and you will later become the CEO. It wasn't an overnight process. What was your secret sauce for your professional success?
I worked harder than everybody coming up, and I let the chips fall where they would fall, right? I came in early, I stayed late, sometimes to my detriment. So my secret sauce was just hard work. And I will tell you as an employer now, you can tell when someone is really giving you everything they got. And sometimes too, hard work isn't necessarily the hours logged, right? It's how hard are you working when you're here. So I'm not suggesting you got to come in first and stay late, because I think we do need better work-life balance. But at the same time, when you're on the clock, be on the clock, man. Give it everything you got. We have about 110 employees here. And sometimes people say, well, that's not my area. Well, no, it really is your area, because the success of the company is dependent upon everybody working well together, right? That's like a right fielder in baseball saying that they don't really need to know what pitches that the pitcher's throwing. No, they really do, because if the hitter's favorable to hitting that particular pitch to right field, then they need to be prepared, right? So I think when you look at it from a team perspective, hard work, insatiable learning, really coming in and giving it your all, that's how you're successful.
We are going to go ahead and go into the lightning round. Best advice you ever received?
Best advice I received was from my business mentor. He said, "You'll never find yourself until you divorce yourself from you."
Fill in the blank. Leadership fails when
It's about you.
clock hit zero. How does Chuck Adcock want to be remembered as?
You know, when the clock hits zero, I want to be remembered as someone who ran the race well and got every bit I could out of that one lap around the track.
Hey, Chuck, I appreciate you for coming on the podcast. With you listening, don't forget to hit the like, comment, and subscribe.